Hey guys, Robert Borsellino here, giving you an update about what happened today, September 15th, 2024. The government announced today a change in the mortgage industry, the mortgage rules in Canada. Some big changes, some stuff we haven't seen since 2012. Very interesting. Let's talk about the changes. So, change number one, the limit on insured mortgages is going to increase from $1 million to 1.5 million. So what does that mean? That means that anybody that wanted to get into the housing market and wants to buy a property that's priced above $1 million but below 1.5 million will now be able to do so with a smaller down payment. So basically right now, if you look at the current grid, and you're going to put 5% down on the first $500,000, 10% down on the difference. So if that grid remains the same, we're looking at then 10% up to 1.5 million. They might change the thresholds a little bit, but the point being is it's most likely going to range in that 10% down payment, which means for a $1.5 million home, you're no longer required to put 20%. You can most probably do it with 10, which means $150,000 down payment instead of a $300,000 down payment. So it'll allow buyers that want to buy in that price range to be able to now get in with a smaller down payment. Second change is the amortization on, again, insured mortgages. So for conventional mortgages, it already exists. If you're taking a conventional loan, you could get a amortization up to 30 years. Now in August, the government changed and added a 30-year amortization to new construction, so new builds on insured mortgages. And now, effective December 15th, when all these changes come and take place, they're looking at now allowing a 30-year amortization on repurchases. So you could be buying a used home, not new construction, and you will benefit from up to a 30-year amortization should you choose to want to go that route. What does that mean for the buyer? It means that the monthly payments are going to be lower, so they're going to be more affordable, and it means that you're going to qualify for more. So what you can qualify for with a 25-year amortization, by now having the option to go up to 30 years, it'll allow you to get a pre-qualification for a slightly higher amount, being that we can shorten the amortization and give you lower payments. Now, it doesn't necessarily mean it's the right thing for everybody, but for a young couple, for example, it could be the right decision, as if they're getting into the housing market in their mid to early 20s and they feel that very comfortable taking on a 30-year amortization because they're only at the beginning of their career. That could actually be very beneficial for them to get them into the market and have more affordable payments. And it's not for everybody, but it could definitely help quite a few people, especially the younger generation, to get into this market. All right, and for the last change, they mentioned that for anybody that already has a mortgage that's insured, you will be able to shop it around now up for renewal with other institutions and not have to requalify at the stress tested level, is the actual rate plus 2% or the qualifying rate plus 2%, the highest of both scenarios. It'll be at your actual rate. So if the lender is offering a rate of, for example, 4.99, you would simply have to requalify at that rate there and not have to requalify at a stress tested rate, which benefits a lot of people because anybody who purchased prior to 2022 most likely got a very low interest rate in comparison to today's market, and puts them in an unfavorable position when it's time to renew their mortgage. Now with this rule here, they would only need to qualify for the actual rate. So that would mean that if the actual mortgage rate on the market is, for example, 4.99, or whatever it is at the time that you're going to be coming up for renewal, you need to qualify based on that rate and not, for example, 4.99 plus 2%, which would be 6.99. So the reason they did this is because a lot of people that purchased prior to 2022, prior to those rates skyrocketing, were in a position where they simply cannot leave their lender. They're stuck with their lender, and now this is going to benefit them and help them be in a position where they cannot have to stick with the same lender at whatever the lender's offering them. So it makes a little bit more competition, which is good for everybody. And at the same time, I would really love to see the banks adopt this change, not just insured mortgages, but to conventional mortgages, because logic is, I mean, if that's the logic behind the change and not to keep the consumer stuck with the same lender by force because they can't qualify anywhere else, if they made that change for insured, logic says they should do the same for conventional. We're probably going to start with this and then eventually use that as a second or third step in, and as they're amending and changing all these mortgage laws. So we're going to take the good news. It's great news, especially people say, well, you know, in Quebec, it really doesn't impact us all that much because majority of the homes we're getting into that consumer needs help with in terms of the down payment is properties under $1 million. But that's not true, because in Quebec we have a massive amount of revenue properties that are owner occupied, meaning duplex, triplex, fourplex, and the people buying them intend to live in one unit and rent the other units in order to help cover costs. This is where it becomes a game changer. It's on those plexes. It's especially in the area that I work in the East End. There's plenty of them, but all over the island of Montreal, all over the province of Quebec, we have a significant amount of plexes. And going from 1 million to 1.5 is going to actually, in my opinion, allow those properties to go up in value, because the playing game just changed here now. You can buy with 10% and get into a revenue property if you intend to live in it. You didn't see it all that much on the triplexes and fourplexes because they're usually priced over $1 million. The duplexes, well, it depends on the area you're buying and whatnot. Some triplexes too under $1 million, but in general, this is definitely going to change that playing field right there on those plexes, because now you're going to have buyers that are going to want to get into that market on those plexes, and they have the necessary down payment. It's going to grow the potential buyers in that market. And they're going to have a higher probability qualifying for revenue properties such as a duplex, triplex, or fourplex than they will in a single dwelling, because the revenues are going to help their servicing debt ratios in order to qualify. And therefore, I think you're going to see a very big demand going into that market on the plexes. So keep an eye on that. Food for thought. Let's wait for some more news from them. Let's get some more details, and I'll keep you guys informed as we go along. But for today, that's pretty much it. Have a good one.